My name is Nick Bender. I'm a second-year director of the Anderson Investment Association and of the Fink conference for the second year in a row, and very pleased to have you all here with us, as well as our distinguished panel this morning. I want to quickly introduce everyone, moving from left to right over here. We have, first of all, Doug Macbean, who is the Director of Public Markets at the Caltech Endowment and a UCLA Anderson MBA graduate. To his right, Michele, Layne, who is the Regional Director of the Los Angeles office for the SEC, Securities and Exchange Commission. And to her right, we have Jade, Shopp, who is a partner in financial services advisory at Deloitte. Moderating our panel today is Bob Feldman, who has kindly agreed to join us from the UCLA College of Law. So thank you all very much for being here, and Bob, take it away.
Thank you. Good morning. So the panel today is, of course, on regulations and the impact they have on investing. We have a diverse and interesting group of an actual investor, a regulator, and a consultant. So I think this is not three men walked into a bar sort of thing, but it's somewhat similar. And but I think we'll have some good perspective on the way in which regulations would affect investings, and the subtitle of this program is Looking Ahead. So many regulations look backwards, I think, at past experience, but I think this panel hopefully will be able to talk to you a little bit about predictions and ways in which you can factor in the impact of current regulations and changes to regulations going forward. What I'd like to do to start is ask each of the panelists to describe a little bit about their background and their perspective on how their current position is affected by their overview of regulations and how that works in their job. So Jade, if we can start with you and just move down and take a few minutes to talk about that, please.
Great. Well, thank you, and thanks for having me today. As introduced, my name is Jade Shopp. I'm a partner at Deloitte. I've worked in financial services for the entirety of my career. Maybe to just walk you a little bit along the journey that I feel like has some interesting perspectives that I've gained over the year. I actually started with a boutique firm in the Midwest in Kansas City, Missouri, where I worked with probably some of the smallest banking organizations in the country that focused on ag lending, some commercial lending there. After a couple of years from that, I went immediately to work with some of the largest banking institutions in the world, working in New York for several years. And as a part of those years, I was a specialist in our capital markets practice. And I had the opportunity to work with a lot of the investment banks in kind of a little bit of the heyday of derivative products, structured transactions, when securitization was really coming about, and had some very unique experiences around some of the structured products that came to have a pretty direct impact on the financial crisis that was looming, several years later. But after a number of years in New York, I was with my firm in Tokyo, Japan, for about 3 years, again working with very large banking institutions, most of which were U.S. banking institutions that had a large footprint in Japan and were rapidly increasing their footprint across the Asian markets between credit card business in Korea, equity business that were traditionally kind of based out of Hong Kong. And that was really kind of the start of the push into China and India. And then in 2007, rather than going back to New York, my firm asked me to come to the West Coast because we had a number of large clients like Washington Mutual and IndyMac and Countrywide that had some rapidly growing businesses, and had the opportunity to work a little bit more directly in the mortgage space, which was a little bit painful, but a lot of the capital markets experience that I had really came into play there, and kind of firsthand experience seeing everything's crashed down, but also interestingly over the course of several years later, seeing a lot of those institutions kind of rise from the ashes, some of those being purchased from some of the much larger institutions back east. Some of them were of notoriety that contributed to making one of the first kind of man-made SIFI here a couple years ago, when one of the local Los Angeles banks was acquired by an institution back in New York. So really interesting experiences there. And I would say over the course of about the last 5 years, I spent a ton of time on kind of the emerging financial services sector. Spent a lot of time in private equity, a lot of around growing hedge fund managers. And last couple of years, I've spent a lot of time in the fintech space around payments and consumer lending. So pretty diverse financial services experience, but definitely kind of banking and investment management at the core.
Good morning, I'm Michele, Layne, and thank you so much for inviting me. It's a pleasure to be here today. Before I say anything beyond that, I need to give the SEC requisite admonition, which is the views I express today are my own and don't represent those of the Commission or its staff. So as the regional director, there are 11 of us. Each heads a regional office, of which there are 11 nationwide. Los Angeles, we have approximately 190 employees, and we're the third largest regional office. At the regional office level, we have two program areas, enforcement and the exam program. So unlike the home office in DC, which also has the Division of Investment Management, the Division of Trading and Markets, Division of Corporation Finance, which we also sometimes refer to as the policy-making divisions, because each of those divisions promulgate and are involved in rulemaking, and the regional offices are not. That being said, of course, the findings of our examiners, which are commonly referred to as the individuals in that program, are the eyes and ears of the Commission, because they are in some of your firms and oftentimes observe and identify trends in potentially problematic areas from the viewpoint of a regulator first in time. So I think, as everybody knows, the mission of the SEC is threefold. One is to protect investors, two is to facilitate capital formation, and third is to maintain fair and orderly markets. And so at the bedrock of really each of those three subparts of our mission is one of disclosure. And if you think about it that way, I think it does sort of provide the thematic and goal nature of each and every regulation that is promulgated, as well as our enforcement of the securities laws and regulations. I know everybody wants to know what is going to happen going forward with the Commission in the new administration, and none of us has a crystal ball. But what I can provide is a little bit of context of how new administrations affect the agency's work. So first, and I hope this isn't too much inside baseball, but we have we're an independent agency, and we have a 5-person commission. 2 commissioners are from each party, and then the chair is of the party of the president. So the current nominee, Jay Clayton, has been approved by the Finance Committee, and I believe his full Senate confirmation vote is scheduled for the end of this week, or it might have been pushed to next week. And so when he comes on board, there will be 3 commissioners. We have 2 vacancies, and in order for an enforcement action to be brought, or a rule to be promulgated, as well as setting the agenda for the rulemaking, that is the purview of the chair to set the rulemaking agenda, and also controls the enforcement calendar. And as far as actually passing a rule or authorizing an enforcement action, you need a majority vote of the commission. And so, as you can imagine, right now we have 2 commissioners, so if it's a split vote, then that is the equivalent of no approval for a rule or an enforcement case. So we are looking forward to having a chair, as well as hopefully in the near term have a full commission with the additional nomination and approval of 2 more commissioners. So that is, like, in broad strokes, just the organization of the commission, as well as what the work of the regional offices do.
Good morning. My name is Doug Macbean. I'm the Director of Public Markets at Caltech. and an alum here of Anderson. It's going to be back on campus. So I am part of a 6-member investment team that oversees the university's endowment. It's about $2.5 billion. My career started in the late 90s in San Francisco in the .com 1.0 madness in sell-side research, working for a bank called Robertson Stephens, which many of you probably have never heard of because it went down in 2002, along with many of a lot of our coverage list. From there, I jumped over to Jefferies and helped found their tech practice and research again in San Francisco, and then in 2006 made a wholesale change and jumped over into the allocator side, eventually joining the Stanford Endowment in 2007, where I worked for 5 years as part of the equities group, focused primarily on US and long only and US long short strategies. I joined Caltech right after Anderson here in 2014 to oversee the global equities book. Amounts about 35% of the pool. I also oversee the long short book in our event-driven hedge funds, which are probably another low teens % of the book. So about half of the endowment's assets are my purview. We are a fund-to-funds model like a lot of our peers. So we almost never do in-house investing per se. Most of our investments are bigger picture allocator decisions. Once we've decided where and kind of what kind of asset class we want to make an investment, we then go on the ground and meet with dozens, if we need to, investment firms that focus on that kind of strategy and make our investment and manage the relationships that way. So currently we have 15 strategies in the long-only book, and average tickets 2 or 3% of the endowment, just kind of give you some sense of how we do and what we do. As far as regulation as pertains to my day-to-day role, it's quite limited. I would say where regulation and where we spend more time thinking about that is in the firms that we choose to engage and to employ as managers. There, especially in the hedge fund side, rulemaking and changes in regulation, geographies, things like that. We have some investments in the China A-share market, for example, the local market in China. You got to get your head around a lot of regulation. And so I think that's where my commentary might be most germane today.
Well, so I have a list of questions from students, and now hearing each of your presentations, it occurs to me that we are have been, and will continue to be, especially with some of your backgrounds, in a world of really rapid technological change. Those technologies, whether it's algorithmic trading or it's different kinds of analysis, your background in the tech sector and some of the rapid changes there. Let's spend just a minute, if you would, talking about where you think existing regulation gives insight to decision making about technologies that are going on. Certainly the SEC has to think about this, but I would think for hedge funds and others and for the kinds of investments you're making, you're trying to understand, just something as simple as Uber, which is vastly regulated now, or at least fighting regulations left and right. Where do you think that the analysis of regulations intersecting with technology exist in how you do things? And whoever wants to start with that would be good, but I'd like to hear all of you, if you have a thought about it.
I think generally speaking, it exists at the level of the investment firm. To use the example of Uber, we have a couple of our venture investments do have stakes in Uber, getting in at various points in their capital raises. All of the noise and regulations surrounding Uber and its CEO and all of that move into India, into China. Those are, I would say, issues that really aren't for us to grapple with per se. It's really up to, in our case, in our view, the venture firms who we invest with to make those decisions as to inform them whether or not to be invested in something like Uber. It's so to the actual specific investment, I don't think of it so much as our responsibility to think about the regulations at the investment level. I think taking one step back and thinking about regulations that might impact the investor, I think that's a very different decision for us. And so I mentioned, for example, the A-share market and regulations that we need to get our heads around. Money can go into China quite easily. They're more than happy to take your money through the QFII and our QFII program. It's a little bit of a question about how easy it's going to be to get that money should you want it back. And I can speak, at least at Stanford, we went through the exercise of just taking a small incremental piece of a very large investment we had made in the A-share market just to test the waters, just to see what it was going to happen when we actually put in a redemption request. And it actually worked out fine. It moved as it was supposed to. But there was a bit of holding your breath. Was this going to become a big issue with Chinese regulators?
I guess just one question though, in your evaluation of the people you put your money with and they describe to you their strategies, is it important for you to have a sense that they have a firm control or grasp of the regulations that are going to be applicable in those circumstances? In other words, would they, the vehicle that you use to go into China, for the person to explain to you how he thinks he's getting his money out?
Yeah, absolutely. So the due diligence process, especially for an investment like that, a lot of time is focused on back office. We're going to be on the ground. We're going to meet with the back office team itself. Our ops team might actually go on site, make the trip all the way out to Beijing in this case, to meet with them as well and get our hands around all of this uncertainty. The challenge sometimes with something, say like venture, is you don't know what they're going to invest in. You're just giving them an investment up front for them to go make investments. You don't know where that's going to end up. So you have to trust that their due diligence will be sufficient.
But your diligence of them is to the granular detail of how they've answered some of
Yeah, absolutely. Even in the long only space, for something much more traditional, a 20 stock, U.S. Large cap portfolio, we're still going to spend time with the operations staff to understand, their accounting, their compliance, all of that. I mean, one very tangible change of regulation on the long only and hedge fund space is when I started Stanford 10 years ago, I can remember org charts being, 4 individuals on the investment side and 5 individuals on the ops side, and that was $1 billion hedge fund. Now it's the same 4 investment side and 20 or 30 on the back office side. I mean, the org charts have become so disproportionately skewed over to the ops side. And with that comes a whole host of knock-on effects, which could be for another question, but as to how 2 guys in a Bloomberg is a tough model now to get a hedge fund up and running. And does it naturally bias just the bigger guys just getting bigger and bigger and bigger because they're the ones who have the scale and the size and can afford the enormous staffs that are now required?
Mm-hmm. Jade?
Well, yeah, I might take this in slight different direction. I mean, the intersection between regulatory change and technology is a huge conversation today. I think on one hand, you do have all those mega banks, the very large banks that were subject to Fed supervision, OCC supervision, that I can tell you from personal experience, they became so large over the years in part through acquisitions, and they had very disparate technology infrastructure. And so when it came to complying with some of the very rigorous demands of Dodd-Frank or any of the other regulations, like a lot of what they've been wading through is just actually understanding and kind of untangling their own technology environments to get to core product level data. And a lot of their efforts, I would say over the course of the last 3 years, once they actually got some of their regulatory reporting in decent shape, is actually just kind of reconciling all that information in a massive infrastructure. So that report that is going to go to the Fed makes sense somehow with the report that's going to go to the SEC, maybe in their consolidated financial statements, and also makes sense to what they're maybe saying to the investing public. And there's just a massive infrastructure inside of those banking organizations that have had to evolve and to make sense of the data and the infrastructure. And in today's environment, there's a huge growth of actually the reg tech space. So innovation and technology, specifically addressing automation of those processes, of those data, primarily inside of the banking institutions, but that is seeping over into the investment management sector as well, where regulators, LPs, investors want to have better transparency into investment level information, better understanding of how returns are being calculated. And so, some of that demand for investment managers to have better technology inside their shops is evolving as well. And so, like that reg tech space to meet the constant demand of regulation is a very hot space right now. And there's a lot of innovation in that space directed specifically, not only regulation that's coming out from the Fed or the SEC or the OCC, but state regulators, the ECB in Europe, and foreign regulators, especially for those very, very large sectors. The other angle that I thought might be worth commenting on is, One of the other regulators, the OCC, which is predominantly a national bank regulator, came out with some proposed rule sets for offering national charters for fintech companies, so they would be regulated basically on the same basis as a bank. And they've largely finalized those rules, but it's a pretty interesting concept to where you might have a banking institution like out west here, like Zion's Bank or what was City National Bank, having the same regulator as like a PayPal, which most consumers think of as just facilitating peer-to-peer payments, but the reality is that payment facilitation is kind of a core banking activity, traditional banking activity. You may or may not, some of those consumers may keep some cash in those PayPal accounts, and they actually offer consumer credit and working capital lines to some of their merchants on the other side of this transaction. So very quickly you start to see how companies like that, maybe the lending clubs of the world, the Prospers of the world, at least right now have the opportunity to apply for a national charter, where today they're really just subject to state-by-state regulation. And so you have regulators like the OCC trying to maybe centralize that regulation a little bit more, and having those really highly innovative companies, maybe opting in to a regulatory environment that, a couple years ago may have seen to be, very burdensome. So some really interesting intersections, I think, between regulation and technology.
So as a quick follow-up to what you just said, and then going to Michele, because can the regulators keep up? I mean, what you're talking about are mergers and changes and change. I mean, this is what technology is. The internet has made PayPal, a huge enterprise, and all of these, a Prosper and Lending Club are big deals now, and they're very worth it. But do you think, from your perspective, are the regulators keeping up with these changes, much less the regulations themselves? Do they have the powers, or are there gaps that are being exploited? I don't want you to give away any whatever, just if you have some general idea about not necessarily any one particular enterprise.
Yeah, I think that they're doing a much better job at it today than they were 10 years ago, because most of these regulatory agencies themselves are investing a ton around analytics. They're investing a ton around research, around some of these innovative business models, so they can make informed decisions around what type of regulations might be appropriate for those emerging business, how they might actually examine those types of organizations. So I think that they're investing a ton on their capabilities, their research, analytical capabilities, and they're being pretty thoughtful, I think, about what fits in the model, what might be thought about a bit differently. So a lot of it, innovation changes, and moves at a pretty rapid pace. So I think it's hard for any regulator to, stay one step ahead, if you will. But I think they're doing a much better job at it today than they were maybe, 8-10 years ago.
Michele, what is your experience in terms of keeping up with the technological changes and all that?
So sure, that's a good segue. And in my first remarks, I forgot to mention that I am an SEC veteran. I've been with the agency the entire time in the LA office for 22 years. So I agree with Jade that I think the agency in many ways has really been transformed in the wake of the financial credit crisis of 2008 on a whole variety of aspects, but most prominently now I would say is just the inclusion and a lot of resources available to us, which we've been able to devote to technology as well as data analytics. So one of the divisions in Washington that I mentioned, the Division of Economic Risk Analysis, and that division provides support to many other divisions, including the rulemaking, because before any of the rules are promulgated, they need to do an economic analysis of proposed rules. And in addition, they provide a lot of economic support for enforcement cases, examinations. And then in addition, there, in every division now within the agency, are large data analytic groups, including in the examination program, there's a quantitative analytic unit that essentially are comprised of PhDs, including a rocket scientist from Caltech, literally, who develop their own software programs to be able just to deal with just the volumes of data, which we know is just part of life now in our world. And so I think now the agency has really evolved from big data to smart data. And of course, it is always a challenge that as a government agency, resources are limited and can't match those of the private sector in many regards. But the emphasis clearly on the examination program in particular, and in the asset management area specifically, is to do a risk-based approach, because as I think most people know, the number of examiners that the number of firms that our examiners are able to go out and inspect is roughly 10% of the population. So you must have a risk-based approach to try to cover that landscape. And part of that risk-based approach is using a lot of data analytic tools. Then as far as the technology, like the algo trading and all the other innovations in trading itself, some has been addressed by rulemaking, and I think that will continue. But in many other regards, the securities regulation framework is a principles-based framework. So at the end of the day, you can have extremely sophisticated technology that the experts in the agency and the people on the field try to understand. But for any regulatory body to have any teeth, is you have to have an enforcement component to enforce the rules that you're seeking the firms to comply with. And at the very end of the day, if there is an enforcement case, that ultimately is going to be tried before a fact finder, and the lawyer for the agency is going to have to make that an understandable case and tie it to, again, the bedrock of the securities regulation, which is disclosure if it involves an asset manager or an investment advisor, whether or not there's been compliance with the fiduciary duty that an advisor has. So technological and data analytic capability has been significant in the last 10 years, and I would say even every year it continues to improve and try to, if not be ahead of the curve, at least keep pace.
So all three of you are veterans of a lot of change in the environment. And you know, we learn a lot from the mistakes of prior events, whether it was the tech bubble or the financial crisis of 2008. Many times, I think in those things, in a prior life, I was involved in some reasonably large reorganizations, bankruptcies, before I accidentally started teaching. So can you spend a minute, based upon your experience, to say how your experience with regulations that didn't cover the problems that existed? Now, some of them were economic, but some of them were regulations. Enron, for example, took advantage of some FASB regulations that sort of got distorted and that sort of thing, and weren't caught and weren't whatever. But there are a number of examples of how these things happen. But if you could just spend a minute talking about how, after the fact, you've analyzed the regulatory failures that now inform what you currently do and how you think about things. Doug, you've had the longest time to think about this question, so because you're at the farthest end there. So do you have any thoughts about that? Is that question making sense to you? Or?
Yeah, one thing that pops to my mind is, my first job out of college being in sell-side research in '99. It was kind of laughed about, but in all truth, from my experience, it really was largely true that we really were an extension of investment banking. it was to be a Chinese wall. I was 22. I didn't really know better. You kind of, it was a fun time. It was a heady time in San Francisco. So you just went with it. But in hindsight, I'm pretty sure that some things that were going on were probably not above board. And in some ways, those conversations with bankers and, never was there direct pressure about, you need to have this rating on a stock, although I don't doubt that that occurred in some parts of the research banking world. Definitely a very shade of gray in there that I think
And
was...
do you think about things differently now as you analyze,
Well, I
based
imagine
upon the breach of the Chinese wall or that kind of thing?
Again, I think if I was more involved in day-to-day and with regard to paying attention to sell-side research and what analyst ratings were and kind of what the levers are that are driving their motivations, I think I would have, and I do have greater conviction that sell-side analysts are more independent today than they were vis-a-vis 20 years ago. I do feel that. Do I still think there is probably under the radar some, let's walk out for coffee, let's not do this on email kind of going on? Probably. I mean, that is the nature of banks and trying to make a buck. So I guess I'm not in the weeds enough to be there, but I would say that's one experience I had where I know strict enforcement was put into place. Chinese walls were built. I can speak when I was at Jefferies, for example, every single conversation with a banker had a compliance member on the phone. You were not to have any, and we didn't. So, those were tangible examples of regulation coming in after the fact to, I think, correct what was a very real problem that was distorting markets and hurting average investors.
And learning from the crisis caused people to think more carefully about regulations and the way in which they would be enforced, and that again, in your looking at compliance, you probably subconsciously ask questions.
Yeah, and maybe this guides me a little bit just personally, but I also think, generally speaking, endowments tend to shy away from, say, the type of active trading kind of SAC-ish kind of strategies. And some peers don't have so much of an issue with this, and even Stevie Cohen is coming back. It's indicated he's coming back to market to have LPs again. I can't imagine being an LP of Stevie Cohen at this point, given what he's gone through. I just can't imagine as a fiduciary, first and foremost for Caltech, to be able and comfortable to get in there. Nor do I trust that if I was to actually get in the weeds and meet with his back office team and try to get how this all works and the structuring of Chinese walls, one, if I'd even understand it, and two, if I'd even trust it. Mm-hmm. So perhaps that informs me a little bit in terms of where my own biases are with regard to certain strategies and even certain individuals and the histories of these firms. It probably informs me as I go through my career now, but I don't have any tangible day-to-day example of that in my current role.
Michele, you mentioned that since 2008, the SEC has changed the way they think. Can you spend a little more time on that?
Well, I've just been...
Or your personal view of that.
Sure. So I've just been thinking a little bit about your question and what does it mean when there's a regulatory failure? Does that mean there's some failure on the part of the regulator in carrying out its mission with the tools it has, or is there some gap in our legal regulatory framework that needs to be addressed? And then who and how can that be addressed? So what I think we saw, even going back to the .com crisis and then the Enron era, et cetera, it was through that crisis that there was a call to arms, and we ended up with the Sarbanes-Oxley legislation and a lot of the really important regulatory changes that came through that, including the SOX certifications that are mandated by the CEO and CFO and signing off on the financial statements of public issuers. So was Enron a regulatory failure as far as the SEC didn't find it earlier, or was there just some regulatory gap as far as what the obligations of senior officers of a public reporting company are? So I think many of the regulatory failures really are absence of rules and statutes that can directly address certain conduct of public reporting companies and regulated entities, the entities that we regulate on the financial services side, like the investment advisors, companies, broker-dealers, et cetera. And what you need to address those regulatory gaps, of course, in many instances, is legislation, which requires, obviously, passage by Congress. And that oftentimes is somewhere that can create the challenge for an agency where it identifies certain gaps in the regulations that it enforces and the ability to affect change in the regulations. And so that, I guess, is how I assess the situation. And then, of course, it doesn't mean by any strokes that any agency could do a better job. So a lot is looking inward at our processes and how can we be more effective with the tools we have. And so that is where, again, sometimes depending upon the makeup of the commission, can be more or less aggressive in certain areas in enforcement. And we've seen in the last 2 administrations under Mary Shapiro and then recently under Mary Jo White, especially under Mary Jo White, who herself was a former prosecutor and very supportive of the enforcement efforts.
So, Jade, before you answer that, I'll just make this comment. I think that one of the things that's important in thinking about regulations is all regulations are not governmental. There are FASB rules, there are model rules of conduct for lawyers, there are internal rules for investment banks and processes that are very, very important. And the failure of those rules sometimes relate to individuals' conduct, but there were lots of rules changed besides, in the accounting world and the legal world after some of these major problems. And I think that when you're analyzing regulations, you have to think about the professional regulations or rules that are adopted by organizations like FASB and others that have to be clear and well thought out, and that people can understand and abide by. Jade, I'm sorry, I didn't want to.
No, you set me up perfectly.
I hope so.
I
was
could
trying
tell,
to.
I could tell the audience was just clamoring to talk about accounting for 20 minutes. But, in all honesty, I actually find, topically some of the most interesting things, having been around the capital markets space and then through the credit crisis years, some of these intersections between accounting that's just debits and credits and the economics in the underlying business, and then actually how maybe more traditional regulatory actions might come into place. But one topic where I've spent a lot of time in my career is around a very agreeable topic where everybody always agrees on what is fair value. And it started back in 2001 or so with a FASB rule set around derivatives. And so derivatives, which some argue were the downfall of AIG. But before 2001, there wasn't a single derivative really on the balance sheet. And so investors really had no understanding of what kind of asset or liability exposure that some of the largest banks had on their balance sheets, let alone an insurance company that maybe they didn't expect to have a lot of derivative exposures like credit default swaps and such. And so with concepts like fair value, they came onto the balance sheet, and then you had some accounting, some say trickery, some say complexity, but you could kind of manipulate financial results by accounting elections that you might have, whether that's hedge accounting that a bank might apply at the corporate level. There were such things like fair value option, where any enterprise could declare fair value on their own debt, and so as their own credit worthiness decreased, they actually recognized gains. Some of those types of things were counterintuitive. And as we roll that forward to today, or really even over the last couple of years, what was producing fair value in any kind of enterprise, whether it's a bank or an asset manager or a corporate institution, a lot of times there was very disparate models that were being used, highly judgmental, maybe highly different from one part of the organization to another, maybe even same asset class or product class, but there was no governance around those models. And so there's been a ton of work and a ton of requirements that were put in place as a result of regulation push. Not necessarily like what those models have to look like, but what does the governance model have to be around those models? And so a lot of the big banks and investment managers today are doing a lot, not necessarily on getting fair value exactly right, because that's always going to be judgmental, but putting the governance structure around those types of models. And so there's a rationale, there's consistency. When it's needed, there can be transparency, whether it's be for investors or regulators or auditors. They can actually describe what their approach is, what the mechanics are, what the assumptions are, what kind of judgments are, what kind of sensitivities there are in those models, ultimately to produce, this concept of fair value that is fundamentally important in most financial institutions. And it's still a really hot debate. Some of you might be aware that the FASB and the ISB are actually now have issued their final rule set around allowances. And so when Mr. Keshkar was talking about the sufficiency of capital, when banks have to adopt these new allowance models that are now going to have to forecast lifetime expected losses on loans that they originate, that's theoretically going to raise allowance levels and require higher levels of capital. And so while it's an accounting rule set that is requiring the shift from incurred losses, so a loss when it's incurred, when your borrower, practically, declares bankruptcy, to all the potential losses over the lifetime of that loan, that's very different than what we experienced in the credit crisis. And there is it's a delicate balance between the producers of the financial statements, so let's say financial reporting, the credit experts within a financial institutions, the people that are driving the business, external auditors, regulators, to all kind of circle around those topics. That I think it really creates some interesting environment around a concept that's so fundamentally core to banking institutions, to asset managers. They have to report around on a fair value basis most times. And so that fair value governance and some of the judgments that are used is one topic that I've just been following for my entire career.
Well, to tie two comments together, Doug's comment and yours, I know many of you might want to get out of this panel sort of how do I make a diligence analysis of regulatory issues that may affect an investment I might make. I think Doug's point about the size of the operations staff and your point about the way in which that operations staff reports and what the governance, how those decisions are made, is a very important diligence model. I'm not sure that people can really diligence some of the issues you're talking about. How close are they to defaulting loans, and what does that trigger anything or whatever? That's hard to get into that, but to get a sense of the performance of the governance structure is something that I think Doug would probably inquire about of the people he would invest, and something that you would try to design. One of the topics, and we're going to try to take some questions as well, so hope you're preparing your questions very carefully and perfectly organized. But one of the things that we talked about downstairs that I think is very important is there are all these pronouncements now from the new administration about policy changes, radical policy changes towards regulation, towards whatever. I think one of the things that we talked about briefly before we started the panel downstairs was how difficult are the process of actually changing a regulation and what's involved in that. And I think before people take too much or make too many decisions about these broad executive orders or policy announcements that we're seeing today, just a kind of a brief description in your experience, Jade and Michele, about what's necessary to actually change a regulation and the time it takes to do that.
Well, as I alluded to in one of my previous answers, obviously, certain, for instance, rollback of Dodd-Frank would require congressional action. So one can all figure how long, if ever, that might take. Then on the rulemaking side, as I mentioned, the chair of the SEC sets the rulemaking agenda. And so, for instance, much has recently been spoken and written about the conflict minerals rule, which is a rule that applies to the MD&A section of your financial statements for certain companies. And that rule has been with some controversy, and if the chair of the SEC wanted to prioritize rulemaking on that, then that gets a priority over other rulemaking. So, but again, that takes time because just under the rulemaking authority of the commission, as I mentioned, an economic analysis has to be performed, proposed rules have to go out for notice and comment, and then it requires a majority of the commission to pass that rule. So for instance, one of the important reforms under Dodd-Frank was the establishment of the Office of Whistleblower and a formal whistleblower program for the agency within the enforcement division. And when many of those proposed rules went out, there were numerous iterations because, just for instance, one of the more controversial aspects to the rule were the reporting up within an organization before going to the SEC or other regulator or law enforcement. And so some rules can take an extraordinary amount of time and resources to get them passed. So those are just a few kind of divergent examples of what it takes to affect rule and legislative change. Then, of course, the other aspect that we don't have control over are the court rulings. So, part of what always makes it exciting to practice at the SEC and in the securities area is almost every term of the Supreme Court, there can be a pretty significant and profound decision that affects the day-to-day work of the agency. So, for instance, the Janus decision that came out about 8 or 9 years ago, which held that only a maker of a statement can be held liable under Section 10B of the Securities Act. So then that became a challenge in some cases where the actual author of the 10K or prospectus or press release was not the person with the knowledge. So that's just an example, or if any of you follow the insider trading laws, there was a significant decision in the Second Circuit, the Newman case, which basically changed the liability standard for a remote tippee, someone down the insider trading chain, and then that was from the Second Circuit. Then the Ninth Circuit had a case, the Salman case, which went the other way. And just this term, the Supreme Court went back and reaffirmed the Dirks case, which then went back to the earlier standard before Newman, where you didn't have to prove that the downstream tippee, the close relationship that's required to breach a duty, was not a quid pro quo relationship, essentially. So all of those factors go together as far as how change can be affected when it's not so simple as a pronouncement from any one part of the government to change something. And then, certainly there are priorities are set by the agency, so depending upon the objectives of any commission, there can be more activity in one area or another. But one thing I have seen in my time at the commission is those generally are not politically motivated, but the agency in some ways is reactive to what occurs in the market, as well as proactive, trying to get ahead of potential problems and challenges before they cause investor or market harm.
Yeah, great comments. I don't really have a whole lot more to add, but maybe just kind of an acknowledgement that, going back 2, 3, 4 months, there was a lot of executive actions that were being put into the public domain by the new administration, and And some of those do have some teeth, but as Michele indicated, that many of those, especially the ones that might specifically or directly pertain to aspects of Dodd-Frank, probably would take an act of Congress to actually affect a change. And so regardless of the commentary around regulation being swung too far and executive actions going to address certain things, there can be a pretty complicated web and requirements for actual rulemaking change to take effect. And in many cases there are lengthy comment periods and that sort of thing to make sure to incorporate all the constituents' thoughts on such change. But I think we will continue to see, or I think that the regulatory environment will be continue to be interesting to monitor. In particular, like efforts around the Department of Labor's fiduciary rule that was supposed to come into effect this April. It's now been delayed out until June, in part because some of the impacted parties wanted more time in trying to decide what actually does it mean to be acting in a client's best interest and that sort of thing. So I think for the investment management industry, it'll be interesting to see what kind of change can be affected either by massive change, by trying to eliminate the fiduciary rule versus delaying it and those types of things. So I think that there's going to be a lot of dynamics interesting to monitor over the course of the next 9 months to a year.
One of the things that, if you would comment just briefly, Jade, is that because of the long time that it takes for these changes to occur, because of the rulemaking process for the fiduciary rule is a great example. There was an article in the Journal a few weeks ago, or a week ago or so, that said that many of the banks, although the rule is not now in effect, it's been postponed again, have already changed to a fee-based management versus a commission management, and that's the new business model, based upon whether that rule was going to be enacted. And now many of them have realized that there may be better economics for them under the fee-based than the commission model, and will adopt this. I don't know if that's an unintended consequence or whatever, but you're advising clients as they're looking to make these changes ahead of the rule. What kind of analysis goes on in that way? Sort of as a competitive matter with their peers. If it's going to be imposed on everybody, how can they take advantage of it?
Yeah, and I think it's a good comment. I think that the reality of it is, especially with larger institutions that had been working on their implementation to be compliant with the fiduciary rule, had been working on it for quite some time, and not just working on it to comply, but actually try to make their business model work underneath the new rule requirements. But also, it's not just shifting the business model to make the economics work. I mean, I think that clients were demanding a different type of service, and especially when there's so many more choices out there, product choices, transparency of information. I think that the competitive environment is actually kind of pushing many of the market participants to move in a direction. So most of the large clients that I work with are continuing on their efforts to implement and become compliant with the rule, move to more fee-based arrangements and that sort of thing, because their clients are asking for it. And so I think many see a benefit in it. It's just they're still a little bit nervous about getting caught up in kind of the minutia of the regulation that they still worry about a little bit.
Thank you so much for coming to speak to us today. My question is, the number of public companies is significantly lower than the peak in the late 90s, and some ascribe this to Sarbanes-Oxley and the increased cost of reporting and audit requirements. First, do you agree with that assessment? And second, is a smaller number of companies on public markets good or bad for investors? Thank you.
So maybe, Michele, if you'll answer the first question, and Doug, would you answer the second?
Well, that's a complicated question, and certainly there are different views. There are some people who feel that is the increased expense of going public and the, quote, burden of being a public reporting company is in part responsible for the lower number of IPOs that have been filed in the last couple of years. And then there are other schools of thought that there's so much cash available in private equity and other sources that that can be part of the rationale. And I'm sure with a lot of things, the answer probably is somewhere in the middle. And while certainly compliance with the federal securities laws when you are a public reporting company undoubtedly exists, but I guess my view would be, as a regulator, it behooves private companies to have good, robust corporate governance, internal controls, and many of the requirements that exist under both SOX, Sarbanes-Oxley, and all the other rules and regulations. So I don't think it's an unfair burden, and when you access the capital markets, I think it strikes me as fair.
Doug, what do you think about the second part of the question about whether having fewer public companies is good or bad?
I guess I'd kind of punt. I'm not particularly sure one way or the other if I think it's good or bad. I guess if I don't believe the numbers. I mean, I don't feel like there's gone from 10,000 to 500, in which case I would say it was decidedly a bad thing. Generally speaking, my sense, having been involved with the public markets for 20 years, is there's still, thousands of companies, at least in the U.S., and thousands more outside the U.S. to invest with. I still think it's a robust marketplace. It hasn't been my experience from anything I've seen or any of the investment strategies I've been involved with, managers I've spoken with over the years, where it's been a problematic thing.
Okay.
Thank you.
Yes, sir.
Hello, John Brunson, Skyline Financial, UCLA Economics 19, Humana. This is in regards to the topic of fintech, and specifically the space of consumer finance, vendor payments, small business, and the ability for those verticals to focus on customer experience and with a lack of regulatory concern. My assumption is that they're under the ILC, talking about the PayPals, et cetera, and they're not under OCC, and they're SEC only if they are publicly traded. Does that lack of regulation assist them in focusing on vis-a-vis somebody like a B of A, Wells Fargo, or Chase in capturing the consumer and small business market?
I can start. So most of the payments companies out there, they operate with a payments license, at least the ones that operate in the U.S., which are regulated by the states. Probably the two most strict states that are out there is our lovely state of California and the state of New York. And so when the OCC rolled out the national charter option, banking charter option, there's actually quite a bit of disparity around. You've got state regulators that think that they've been doing just a fine job and maybe even more rigid requirements, and you might have companies kind of gaming the system and getting out from underneath the state regulatory auspices into a centralized regulator like the OCC. It gets a little bit more complicated, well, a lot more complicated when you're facilitating payments across borders. Not just the United States to Japan, but from the Czech Republic into the UK, where Brexit is going to have an implication on how payments are facilitated. So I think some of the players out there are really considering and really exploring what it would mean to be under the direct supervision of a regulator like the OCC to maybe reduce the number of regulators that they have to deal with, reduce the number of state that they have to report to, and while they might be subjected to more rigorous kind of maybe full-time examination staffs, especially for the larger organizations, that maybe the inconsistencies between the states might be a business model advantage that they can take advantage of. But I think that the OCC first put out kind of their conceptual framework for how they were thinking about fintech about 18 months ago, maybe even a little bit longer, just for public reaction. They've recently advanced that rule set largely into a final construct, and so it's been something that's been out there for a while, and those business models and the products that are offered by some of the fintech companies out there, whether it's consuming lending, core payments companies, it's just evolved so quickly So, not to share my firm's view, but my personal view, I think it actually can be a competitive advantage if they went to, maybe a centralized regulatory body to oversee their business.
Does that require depository, that's assuming they're a depository funds institution?
So in the banking environment, there's basically 3 different activities that the OCC considers to be banking activities for the license. 1 would be payment facilitation, 2, collection and maintenance of deposits, and 3, lending activities. And so many of those payments companies, they do have some sort of consumer lending product, that sometimes it's comparable to like a credit card loan. Some companies like Square, that is facilitating payments. They offer working capital loans to the merchants that they're facilitating payments for. And so they're in the payment space, they're in the lending space. I'm not aware if they collect deposits, but I don't think you have to check the box on all 3. But if you're doing any of those type of banking activities, you can at least apply for a charter. That's not to say that the OCC would necessarily accept and grant that charter, but I think any of those attributes would be the basis for an application.
Michele, did you have a comment on that? Or?
No, I mean, unless there's a public holding company under which the lenders operate, the SEC doesn't have jurisdiction.
Okay. Yes, ma'am.
Hi, I'm Suzanne Moline, UCLA undergrad, UC Hastings Law School. I think it's pretty well established that small investment management firms outperform large hedge funds, but the regulatory burden has definitely, I think, deterred all but the most determined money managers in the space. One innovation I've seen is the rise of kind of outsourcing opportunities for CFOs and CCOs as a way of smaller firms tapping into more sophisticated resources and maybe be able to take advantage of some fintech that wouldn't be available to smaller firms. Like, have you come across any firms that have used these services, and what are your thoughts on them?
So yes, we have, and I think I would say the reactions are mixed. Some are quite capable and competent, and others, just by nature of a CCO's work, it depends on how many clients they have, what time, if any, they actually spend at the registrant. So I think it certainly can provide a good alternative for a smaller firm that doesn't want to incur the expense. But I think, again, like the due diligence aspect is important in selecting that CCO and really understanding how they're going to help the firm comply with its obligations.
And what about on the CFO side?
It's kind of a similar analysis, and we've seen rent-a-CFO types in some public companies as well. And, again, it's somewhat mixed. I think that is a challenging job to be outsourced. And again, it depends on, obviously, just the qualifications and the ability of the CFO. Why do you have a rent-a-CFO? How many other clients does that CFO provide service for? And again, the further removed you are from the day-to-day operations of an entity, the harder it is to effectuate compliance.
Okay, thanks.
I might just address your question too, because I've actually had the opportunity to work with some larger investment managers that do rely on third parties for a lot of their financial production, for accounting on alternative investments that provide the core books and records. Now, I think one of the challenges, especially when an investment manager ultimately needs to report to the SEC, is having enough transparency into what your third party is doing to where you can ultimately retain responsibility for those financial statements that might get filed with the SEC, or the financial information that gets reported to your limited partners. But I think that is a model that more and more managers are going to explore because of the cost of the core infrastructure and technology that it would take to keep pace with some of the requirements. And so I think you'll see more of that. And for the smaller managers, I think while they can have positive returns, margins are still really, really tight, and they don't really have a mandate to add the bodies or the people inside their own shop to do it. And so when there's significant investments in technology to keep up with, with asset growth, reporting requirements, let alone SEC reporting requirements, I think it's something that you'll see happen more and more going forward, as long as they can maintain the transparency and the control to take responsibility of the financial reporting.
Just one brief comment to tie that in the legal profession, there is a model now that I'm aware of a couple different firms that have outsourced general counsels. And there are people with 20, 25 years experience that don't want to work for a large firm anymore, but are very capable, very knowledgeable, who work part-time as the general counsel of smaller companies or emerging companies or whatever. So I think this is a model of, again, in what we now call the sharing economy that has moved into the professional space. So I think this is a trend.
Thank you.
Yes, ma'am.
I'm Darcel Dixon Hunt, representing AFWA, Women's Alliance, Accounting and Finance. My question is about the fiduciary responsibilities of RIAs based on this new deregulation by the current administration. It's my understanding that they no longer have the serious fiduciary responsibility, that they can be laxed and not invest at the best interests of their client. If that's true, how long would it take for that regulation to be put in place?
Okay, well, I can answer that, I think. So as a registered investment advisor, the registered investment advisor has a fiduciary duty that is codified in Section 206 of the Investment Advisors Act of 1940, as well as a very well-developed body of case law, including Supreme Court decisions. So there is no rollback of the fiduciary duty of an investment advisor. Some of the discussion and the challenge has been under the Department of Labor's proposed fiduciary duty standard, which again, the SEC is an independent agency, and so that administrative rollback, or to the extent it affects the Department of Labor's jurisdiction over its registrants and their fiduciary duties, but is one thing. And there have been a lot of discussion over the years of whether a broker-dealer should also be held to a fiduciary standard, but an investment advisor, somebody who is dispensing investment advice for a fee, I think that is pretty solid ground that that fiduciary duty is intact.
Great, thank you.
Thank you all for a great discussion.